How will your financial plan be impacted if your spouse passes away unexpectedly? There are rules for retirement accounts, for investment accounts, and for the tax code that will dramatically impact your retirement. Higher costs and complexities. So understanding the rules that are in place, understanding how the laws work, will help you make better informed decisions. Nobody wants to talk about or even think about this topic, but it's an important one. So in this video, I'm going to help you understand some of the basics to make you better prepared, better informed to make better decisions for your retirement plan. So without any further ado, let's get right into this video. Talking about your spouse passing away unexpectedly in retirement is probably my least favorite thing to go over and even think about. But it's part of my job as a financial planner, and unfortunately, it happens more often than I'd like it to have happen, that a spouse of a client or a client passes away unexpectedly. And not to mention just the shock and the pain that this causes in somebody's life. There are serious financial implications when that happens. You may have heard something called the widower or the widow shadow tax. And what this refers to is a change in taxes that happens when your spouse passes away. And so if you have a retirement plan that has not taken into consideration how things would change if one of you passes away unexpectedly, then you've got a big blind spot in your overall plan. So in this video, we're going to go into some of the planning strategies that are available and understand just some of the rules. Recently, I started working with some clients, and pretty sad story. They decided to retire. They even retired early, and they were in their late 50s and early 60s. They retired, and after just a few months, the husband passed away. They had moved to a new state where he'd be able to ski and, pursue some of their outdoor hobbies that he really loved. And, 6 months later, he was gone. So nobody plans on this on the front end, right? I mean, especially when you're retiring early, you're looking forward to years and decades of great life experiences and really maybe some of the best years of your life. But if something happens that you're not expecting, are you ready? And what would happen to your overall financial situation? So let's jump right into these numbers, and I just want to get right to them, give you some good information. So on the screen in front of us, I've got some important tax numbers, and I want to cover 3 changes that happen when a spouse passes away. So let's just go back to our example of my clients where the husband passed away just 6 months into retirement. So let's say that their monthly spending, their monthly income they're planning to have was $10,000 a month. So the first thing that happens is a change in their tax bracket. So let's walk through this table and see how that change in one of them passing away, how that would impact their overall tax situation. So first, we have the tax brackets. We have married filing jointly, and we have single. So on the screen in front of us, we have some important tax numbers, and there's 3 major changes that happen when a spouse passes away. So let's use the example of my retired clients, and we'll say that their monthly spending is $10,000 a month, or let's just go with $10,000 a month of income. So the first change that's going to happen is how much of that, or I should say, how large of a standard deduction are they going to have? So as a married filing jointly couple, and since this is an early retiree, they're both younger than 65, they have a standard deduction of $30,000. So for $120,000 a year of income, right from there you can deduct $30,000. So only $90,000 of their $120,000 is going to be subject to taxes. Now, obviously, if they have itemized deductions, that would be different, but we'll just use the standard deduction for this example. So when a spouse passes away, the standard deduction drops from $30,000 down to only $15,000. So that means that instead of having $90,000 of their income being taxable, now they have $105,000 of the income being taxable. So number one change is already you're losing $15,000 of tax deductions when a spouse passes away. The second change is in the tax bracket. So now that you have your taxable income, either $90,000 as married filing jointly or $105,000 in the single example after a spouse passes away, that gets taxed at a different tax bracket. So for married filing jointly, for that $90,000, the first $23,800 is taxed at 10%. Then from $23,000 up to $96,950, it's taxed at 12%. So if you blend that together, they're having maybe about, less than a 12% effective tax rate, but their marginal bracket is only 12%. Well, now as a single filer, you not only have higher income more income that's going to be taxable because of the smaller standard deduction. But now, in addition to that, your brackets are compressed, so there's less income in each of the brackets, which means that you're going to pay an overall higher rate. So in the single example, the first $11,900 will be taxed at 10%. Then from $11,900 up to $48,000, it's taxed at 12%. Then up to $103,000, you're taxed at 22%. And finally, that last couple $1,000 from 103 up to their 105,000 that's taxable is taxed at 24%. So all of a sudden, where as married filing jointly, you have less taxable income and you're paying at a lower rate. Now as a single filer, you have more taxable income and you're paying double the rate that you were as married filing jointly. Now you might say that, hey, you know what? If my spouse passes away, our income is going to be lower, or how much I'll need to have will be lower. And that's probably true. You'll probably spend less in a single person household than a joint household. But a lot of the expenses that we have in a household are the same whether you're single or married filing jointly. So whether that's, the amount of your mortgage payment or utilities, some of these things will go down a little bit perhaps, but a lot of the expenses are going to stay the same. So right off the bat, the rates that you pay as a single filer are going to go up. The next thing that I want to talk about is how your Social Security is impacted. So with Social Security in retirement, a portion of your benefit is always tax-free. And depending on how much other income you have, that'll impact whether or not you pay more of your Social Security income in taxes or less. So let's go over that. With Social Security, these are the provisional income rules. So the way that it works is that if your provisional income, which is basically add up all of your other income sources and plus half of your Social Security benefit, and if that number is less than $32,000 as married filing jointly, then none of your Social Security benefit is taxable. If that number is between $32,000 and $44,000, then half of it is taxable. And if it's greater than $44,000, then 85% of your Social Security benefit is subject to taxes. Okay, so if you're a single filer, it's kind of the same story. All of these numbers get reduced. So you go from 32 down to 25, and then 50% of it is subject to taxes if your income is between 25 and 34,000, and if it's above 34,000, up to 85% of your benefit is taxable. So right off the bat, you're going to have a higher amount of your Social Security benefits that will be subject to tax. Now with Social Security, you might think, well, if a spouse passes away, it's going to be reduced, and that's true. But the surviving spouse gets to keep the higher of your two benefits. So, if like a traditional couple, if husband was working his whole life and wife was maybe worked off and on but was raising kids at home, she's going to get to have the higher Social Security benefit when her husband passes away. So if she has a high Social Security benefit, more of that benefit is going to be subject to tax. So now we have your standard deductions are going to be lower. The second thing is your tax brackets are compressed and you're going to pay higher rates. The third thing, more of your Social Security benefit is actually subject to Social Security tax. And I think I only said three things, but I actually want to cover a fourth thing. The fourth thing that happens when a spouse passes away is how it impacts your Medicare Part B premiums. So with Medicare, it's kind of like Social Security, where if you have higher income, you have to pay, with Social Security, if you have higher income, other income, you pay more taxes on Social Security. With Medicare, if you have higher income, you have to pay a higher amount for your Part B premium. So let's start with a baseline. For Medicare Part B in 2025, your Part B premium is $185. Now, who pays $185? Well, if you're married filing jointly, if your adjusted gross income is less than $212,000, then you'll pay $185 a person. Okay. So let's look at what happens if you're single. If you're single, that number drops in half. So if your adjusted gross income is over $106,000, you're already paying that Part B. Where if you are single to be at the lowest rate, you have to have less than $106,000 of adjusted gross income. Now, this is really important. Your adjusted gross income does not take into account your standard deductions. So in our example where they have $120,000 of income per year, their taxable income for the single person would be $105,000 because they have that $15,000 deduction. But their adjusted gross income is actually the full $120,000 because you don't get to take the standard deduction doesn't apply to your standard deduction does not go against your AGI. So for this person, instead of paying $185, now this widow she's going to be in the second bracket here between 106 and 133,000. So she will have to pay an extra $74 for her Part B, and if she has a plan with Part D coverage for prescription drugs, an extra $13.70 per month. So maybe that doesn't sound like a lot, but you can see that all of these things together add up significantly. You have a doubling of the tax of your marginal tax bracket, your standard deduction is cut in half, more of your Social Security income is subject to tax, and you have to pay higher amounts for your Medicare Part B premiums. So with all of this in mind, it begs the question, okay, so I'm not planning on my spouse passing away, but if they do, what could be done? Well, the number one strategy that you can use to prepare for the possibility of a spouse passing away early is to start shifting money from pre-tax retirement accounts over to tax-free retirement accounts as early as possible in your retirement. So what am I talking about? I'm talking about doing Roth conversions on a year-to-year basis. So normally when you do a Roth conversion, what you're hoping for is you're hoping to shift money over early from an IRA over to a Roth IRA, pay the taxes on that, hopefully at a lower rate, so that in the future you can access that money tax-free when maybe your income is going to be higher, or so that at a minimum you don't have large required minimum distributions that push you up into higher tax brackets. Well, if you do this analysis, assuming that you and your spouse, live a long life together and basically pass away at the exact same time, you can map this out and say, all right, well, today with our income, we're planning, like in the example we're looking at, we're going to be in the 12% bracket. And then maybe in the future, if we factor in required distributions, maybe in the future, it looks like you would be in the 22 or the 24% bracket. So with that being the case, it would make sense to take some money out of your IRA, shift it over to Roth, do Roth conversions, maybe up and fully fill up that 12% bracket, or maybe even some of the 22% bracket, so that in the future, when your tax rate would have been higher, you can access that money tax-free. Well, now the math gets even more compelling for a single filer. Because the brackets are lower, because the deductions are lower, that means that as a single filer with the same income, you're going to be in higher brackets already. So if you're married filing jointly today and you're in the 12% bracket, if you compare that with, okay, what if one of us passes away and in the future, we're not going to be in the 24% bracket. The surviving spouse might be in the 32 or 35% bracket. So all of a sudden, it makes more sense to do even more Roth conversions up front to save taxes for that person, for that surviving spouse in the future. And that savings can amount to hundreds of thousands, even millions of dollars, depending obviously on how much overall income you have and how large your portfolio is. But nobody wants to think about this up front. And admittedly, it's really hard to just go ahead and start doing Roth conversions, shifting money over and paying more taxes maybe than you need to. But this is part of what smart planning entails, is understanding what your situation would look like, what your tax situation would look like if a spouse passed away, and proactively doing something about it today so that if it happens, you're in a better spot overall financially. So hopefully this video is giving you some good ideas to understand how the rules work and some of the planning strategies that are available to be best prepared if it happens. If you'd like any help looking at your retirement plan doing this analysis, you can use the link in the description to schedule a free one-on-one consultation. So with that, I hope you have a great week. It's so much fun making these videos and sharing information with you, and I'll see you next week.